Hi guys, I want to talk to you about margin. Margin is an important aspect of trading to understand. If you've got a broker account which gives you leverage, what I mean by leverage is it's part of your position sizes are on a loan. So if you're seeing reference to margin in your account, if you're trading indices, if you're trading commodities, if you're trading gold, metals, things like that, you are likely to be trading in a margin account. So it's really important for you to understand what margin is and how you can use it to help you in your trading and how you can avoid pitfalls with margin. So let's get started into the video. Okay, so you need to think of margin as a deposit. The margin element is the deposit. So imagine you've put a deposit on a car. The deposit is just one piece of the pie. So if they're asking you for £100, depending on the instrument that you're trading, you know, the total price of the market that you've got into, the position size could be £1,000, could be, you know, £500. So it's really important for you to understand what the margin is, what the margin requirements are on different types of markets, and how this affects your risk management and your exposure to the market on the position that you've opened. So I've said here you need to understand what the whole pie is worth, and therefore how much, how much your total position size is. You can lose more money than you're required to put in with your deposit or margin. Example I've given here, if you crash the car and you've just put a deposit on the car and the rest is on finance, it's not the loss isn't going to be restricted to the deposit element. You could have written off the whole car and you've only paid a deposit, so you're probably going to be liable for the whole car. Putting insurance aside, I'm just using a car as an example so that you can think of it in a more simple way, because I think for some new traders, when they go into a margin account, it's just difficult to understand and a little bit overwhelming. So if you think of it as an asset that you're putting a deposit on, it's much more simple. So I've got a little picture here of a pie that's divided up. This is your margin here. The margin is the deposit. Okay, so different markets require different deposits or margins. So some examples I've given you. In my experience, the commodities, things like oil, copper, not copper, that's a metal, cocoa, coffee, things like this, they typically require 1/10 of the value as a deposit. Stocks typically require you to put 1/5 of the value in, 20%. So commodities are 10%, stocks are 20%. Indices are typically 1/20 of the value. You can get more borrowing on indices. So let's have a look. I've just shown you their different slices, different types of sizes of the pie that you can have as margin depending on the type of market. So you can check what deposit or margin is required by looking at the info. So I trade with capital.com. I know some people are not with Capital, but I've just given this as an example. In any app or any broker that you're with, you should be able to click around and find the market info in there. You've got the trading hours there, and you've also got the leverage. So this is crude oil, as I said here, it says 10-1 for the leverage. What that means is for every $10 that I want to trade, I have to put 1 in as a deposit, 10%. So the remaining pie portion is a loan. Since you're only required to put a deposit in, the remainder of the pie is funded by a loan from the broker. And you don't get finance for free. They're going to charge you overnight fees for holding open positions within a margin account. You're paying them finance charges, like you're paying interest. So the amount borrowed to fund the rest of the pie is called leverage. Leverage means funding for like a loan funding. So you can check the total value of the pie, and I've said here you should. So have a look in the trade order. You should be able to see somewhere that the total position, what the total position size is worth. I've given an example of capital.com. If you click on the info bit when you're going to make an order, it tells you, and even after your trades are open, it tells you the trade size and how it's worked out. Be aware of currency conversions. That can muddy the water sometimes if you're struggling to figure out what the position size is worth versus what you expect it to be worth. just bear in mind that they might have converted it via a currency conversion as well into GBP from USD or vice versa. You can also work out what the total position size is from your deposit or margin requirement if you're familiar with the type of market and what types of rules they have with that broker for the type of market you're trading. So I've given crude oil as an example again. If the broker is asking me for £80 as a margin requirement deposit, £80 deposit, and I know that the leverage on crude oil is 10 to 1, what that means is the position size I'm about to get into is £800, and you can scale that up or down and fix the margin based on the position size you want to get into. So, you know, it may be that I want to enter a position size of £1,600, then I'm going to make sure my margin requirement is £160 on the trade order. So I hope all of that makes sense. I've just given you another pie example here. So 1, 2, 3, 4, 5, 6, 7, 8. There are 8 slices of pie, so the total pie would be £800 in this scenario. One of these pie slices, so that's my little dog barking. One of the pie slices would be £80 margin requirement within crude oil, as an example. So understanding the total pie size is really important. I've said this is essential for your risk management. How much have you got at stake in the market? If there was a war tomorrow, how much are you capable of losing? Do you know? Are you aware? You should be aware of this when you've got open positions on the market. This is also essential for you to be able to avoid margin calls. So I'm going to go into margin calls just shortly. Just before I move on, it would really help my channel to grow if you think this has been useful so far. If you could like, share or subscribe to the channel. Any support you can give the channel is really appreciated, and it helps to fund educational videos. I do take time out of my busy life. I'm working still, and I'm a mum. I'm a busy mum, so any support you can give to the channel would be really highly appreciated. Let's just go along to talk about margin calls. So this is something you want to avoid. I've said here, if you are getting margin calls, it means your trading is out of control. These margin calls happen when you do not have enough cash in your account to cover the deposit. And I've said here, beware, this moves with the price of the instrument. So let me clarify this. So an example of a margin call. Imagine your initial trade size is 5,000 and your deposit is £500. Your initial cash balance is 600. So you've basically opened a position size which is £100 less than the total value of the cash in your... You've opened a position where the deposit requirement is only £100 less than the total cash balance in your account. You had £600 in your account. You've opened a massive position size compared to your cash balance, and your deposit requirement that they've taken and ring-fenced is £500. They're going to ring-fence that money. So the price moves. Let's imagine the price moves so that the position is now worth 3,000. This actually wouldn't happen. I'm just giving you an extreme example because you would have got a margin call to block this. So imagine the price drops like a stone to 3,000. The loss realised should be 5,000 less 3,000 is 2,000. You've lost £2,000 on the trade size. Don't forget, we're trading this size. We're not trading £500. The broker has funded the other 4.5k of this position size for you. You've taken it on a loan, and now you've lost almost half the money. So the loss that the broker would need to have recognised from your cash is £2,000. Bearing in mind the position is still open, and this is why you're getting a margin call. But I've said here, you won't have got a margin. You would have got a margin call before this happens, and they would have closed you out of the position before you go into this scenario where you've realised a loss that is where the loss in the open position is worth more than the cash you've actually got in your account. They're not going to allow you to go into this position. So let's talk about what happens in this scenario. If it dips down like a stone while you're in an open position, and you've opened this enormous position which you know, is a massive risk for the size of the cash that you've got in your account. I'm going to show you what happens as a result of that. What happens when you get a margin call. Just as an FYI, I've said here, I'm quite a conservative trader, and I've given you an example of how I control this. So I only use a little bit of margin. What does that mean? I may have something like 80% of the position size covered by the cash in my account. So it would take an enormous loss on the position before I'm sent a margin call. So, you know, I'm only using a little bit of loan compared to the cash balance in my account. I hope that makes sense. So what happens when you get a margin call? The broker is going to send you an urgent message via email or push notifications, depends on the broker, telling you that the cash in your account doesn't cover your open positions and you need to do something urgently. If you do not act in that scenario quick enough, they get no response from you. They will close one or all of your positions, and that this act here of them asking you to deal with it is a margin call. So you want to avoid, you don't want to get any margin calls. You want to be completely in control of your trading. If you're getting margin calls, as I said, your trading is out of control. You might want to consider you know, just doing practice trades until you get the hang of what's going on with the margin. For example, doing microscopic trades, like 50p trades, where your loss is going to be 50p, just so you can get the hang of what's going on. I've taught people trading, and it does take a while for this to all sink in and for it to click really with what's going on, what margin is, what do they mean by margin. Margin is the deposit, leverage is the loan. So I hope all of this makes sense and that you found this video helpful. As I said, it would really help my channel to grow. If you could please give me a thumbs up, subscribe to the channel and share the videos. Thanks a lot, guys. Bye.